Good afternoon, Jags. This is Fahad. Today is Tuesday, November 10th. Let's get started. So we have Chronicle once again here with me. Hi, Chronicle. How are you doing?
Morning. I'm doing well. I'm excited to present this thematic idea today.
Yes, looking forward to this. So this is going to be a single stock discussion on a Chinese company, one of the largest Chinese oil companies called Sinopec, symbol SNP. And this is going to be a thematic idea that will be posted on Jaguar Media website, along with entire discussion with the research write-up and the slide deck. All will be available once this video is completed. Now, Sinopec is one of the largest companies in China, and a lot of the discussions that we will have in this presentation is going to be around the bulk is on the energy market. With the macro environment improving and the overall oil price is starting to see some resilience with a lot of the improvement and the supply being down to the point where it becomes very attractive. Some of these ideas we have discussed already in webinars with JAG clients recently. So with all of that said, I'm going to hand it over to Chronicle to walk us through. Chronicle, tell me about Sinopec.
Sure. So before we get into the company, let's first touch on all the themes we're looking at. So next slide, the first theme I'm looking at is Asia is currently leading the petrochemicals industry recovery, which is consistent with the early phase of global economic recovery in a typical business cycle. So if we look at the chart on the left, we can see that chemicals and automobiles are driving the manufacturing rebound throughout Asia. And there's also a sharp recovery in banking activity, which is an indicator that this strength can be sustained because lending activity drives future output. So these graphs were taken from IHS Market Asia sector PMIs. Right now, we can see all three categories are witnessing faster expansions than even 2018 and 2019. And then on the right side, I have the graph showing future supply and demand projections of ethylene, which is arguably the most heavily used petrochemical in manufacturing. Now on to the second theme on the next slide, which is Chinese refiners and naphtha-based chemical crackers are currently in a unique position. This is on page 3 of the write-up. Basically, as natural gas prices remain elevated, then the US-based ethane players are going to lose their edge over the Asian naphtha-based players when it comes to ethylene and polyethylene production. Looking at the graphs on the left, with Brent at 45, we can see polyethylene cost curve that Asian producers' cash costs would be roughly 25 to 30 cents per pound. That's an extremely narrow difference versus US competitors. And then if we factor in transportation costs, all of a sudden the margin prospects of Asian producers become more attractive. On the next slide,
Let me ask you on the before we go to the next slide. Uh, is there a specific reason why picking Sinopec as a beneficiary of these very trends with the economic growth improving compared to some of the other largest producers that are in Asia? What is the one specific reason for this company that you like?
sure. So Sinopec is very diversified, and they have a stranglehold on eastern and southeastern China in the downstream industry, whereas the other two giants in China are more to do with upstream and midstream. So downstream is the one that sees the most benefit as oil prices inflect.
I see. So that means they benefit tremendously from potential improvement in margin that comes with the rise in crude oil price, as well as from improving economic activities such as auto sales and the overall general manufacturing environment, as well as service environment improving. Now, this is an interesting theme that you have highlighted. The number 3 point of your bull case, which is Buy America, Build America, which is a key theme that we have been highlighting in front of JAG clients for past several months. You believe that it has actually also given rise to Buy China, Build China. Tell me more about it.
Yep. So this final theme, which is Buy China, Build China, as Fahad has been pointing out since early this year, this combination of geopolitical tensions and the pandemic have opened our eyes to the fragility of the global manufacturing supply chain, and this has given rise to what we at Jaguar Analytics call Buy America, Build America. But I think what's going under the radar is the sequel to Buy America, Build America, which is buy China, build China. So basically, over the last couple of years, America's push to become less reliant on China has gradually resulted in China itself wanting to become less dependent on the US. And regardless of whether trade tensions ease under a Biden presidency, China already looks to be dead set on improving its self-reliance. A couple of weeks ago, we had the Communist Party's unveiling of their 5-year plan, and the overarching theme within the Communique was self-reliance, with emphasis on the development of homegrown technologies, infrastructure, which includes road transportation, high-speed rail, electric power equipment, and telecommunications. But to be clear, China's version of buy and build is not completely like America's, where, whereas Trump preaches about near complete self-sufficiency, China is actually going about it by building partnerships across Southeast Asia and Africa. This isn't talked about a lot, but China's foreign minister has been visiting Southeast Asia and Africa a lot more often since this trade war with the US began. And with this pandemic, China has been capitalizing on this period of economic difficulty by solidifying partnerships in these regions. And they also have a close energy partnership with Russia. For instance, Gazprom is planning to almost triple their supply of gas to China by 2022 to 88 billion cubic meters per year, which would be roughly 1/5 of China's entire gas market. So what I'm trying to get at is that while the Trump administration has been trying to get the US to turn to itself, China instead has been improving self-reliance by trying to get its hooks everywhere. So this buy and build concept actually has different meanings for America and China.
Interesting stuff. Now, moving on to this company, particularly the China Petroleum and Chemical Corporation, also called Sinopec. Downstream operations is basically what gets most of the interest. 47% of revenues comes from marketing and distribution. Refining is the other big, large piece of 41%. And then the chemicals are the other piece. The company actually in itself does not own a lot of reserves, if I'm not mistaken, but it benefits from tremendous amount of distribution and selling at the downstream market and benefiting from refining. So a key barometer of the performance of the stock from here would naturally come down to margin and improving overall volume, which depends on the manufacturing environment improving and the overall economic environment improving in China and South Asia in particular. Does the company have any reserves on its own? Is it a driller on its own or not so much at all?
So first of all, there's a small typo on this slide. Marketing distribution represents 42% of revenue, not 47.
Okay.
So regarding upstream, it's a very small part of the business. So as you can see here, 42% is marketing distribution, refining is 41%, and chemicals are 16%. So upstream is they do have drilling operations in across the world, but most of the revenue comes from downstream.
I see. Moving on to their revenues and cash from operations, the trend is naturally as of 2019. This was all before COVID happened. So these charts would show a very different pictures if we had 2020 bars into this picture. But the important thing is that whatever this major slowdown that we saw in the economy in the early part of 2020, and we have seen a massive recovery, a V-shaped recovery since then. My main question about the fundamentals of the company really comes down to something very simple. Explain to me, Chronicle, what is your short and long-term view on the actual price of crude oil? Because ultimately, while we can dive into a lot of the oil companies specifically as to what these companies are doing from marketing and distribution and refining and all of that standpoint, but it ultimately comes down to what the crude oil market is doing to drive the price action in a lot of these big integrated oil companies. So what's your view on that, short and long term?
Sure. So on the demand side, we can see that a lot of economies are still shut down, especially in Europe, and a lot of social distancing in places that are not shut down. So that needs to resolve itself. And even with a vaccine, it might still take time for distribution. But on the supply side, that's when we start to see a lot of capacity getting shut down, capex getting cut, oil rigs getting shut. So supply is tightening while demand is sort of in a limbo right now. But who knows? When that recovers, together with supply that's slow to react to it, that could present some upside for oil, I think.
Before we started this presentation, I was looking at some industry charts, and I was looking at, for example, the total United States crude oil production in the United States, and we hit a peak of 540 million barrels of inventory in the United States sometime around May of this year, and since then it has been depleted down to about 460 million. And similarly, if you look at crude oil production per day in the United States, we hit a peak right in March when things started to shut down, which was about 13.1 million barrels per day. And now the US crude oil production is down to about 10.4 million barrels per day. And then crude oil refinery output is also down from March peak of 17 million barrels per day, currently down to about 13.3 million barrels per day. I mean, and then if you look at the strategic petroleum reserve in the US, that's down about 60% from its peak. If you look at the rig count, which used to be about 1,200 rigs operating, both onshore and offshore in the United States, that's down to only 200. So down almost 80% or 85% basically from its peak. I think we can all see that from the industry dynamic that while the demand side will be lumpy and will take time to recover simply for the fact that we are still operating within the COVID environment. But I think that there is a uniform opinion that at least the supply side has adjusted itself to a level that is extremely low compared to the historical environment. And so, to your point, if the demand side recovers, whether it's because there's a vaccine out or there is a the improving economic picture or macro environment and such, there is a potential sharp recovery that could take place not only in the underlying crude oil price, but also in a lot of these manufacturing companies. Any quick thoughts on this slide? That was just a high level view. Any quick thoughts on this slide?
Nothing to add on top of what's already below the charts. So I think Q3, the company's fundamentals bottom. So net income almost quadrupled on year to 46.4 billion RMB. Granted, a lot of this can be attributed to the sale of their pipeline assets to PipeChina for 30.8 billion RMB. But looking under the hood, their refinery throughput has actually returned to positive territory to 5 million barrels per day. And then separately, refining margin surged 68% to 980 per barrel. So that's on the revenue and income statement side. And now on this slide, just very quickly here, another thing I'll say about Sinopec is that they have no balance sheet problems. It's not exceptionally strong. At the same time, it's not as bad as, say, Exxon's. So the only thing I'll say is that the company has had to borrow roughly 100 billion RMB to pay dividends over the last 2 years. But that said, the cash position currently exceeds debt.
Oh, that's good. Debt to equity ratios are very much in line, although they have gone up a little bit in the last couple quarters. Now, I believe, comes down to the most important one. This is the crust, in my view, of this presentation, which comes down to the manufacturing PMI. When the manufacturing PMIs are improving, the simple logic is that you should see the base metals as well as cyclical names to outperform during this time period. And we are seeing exactly that as we gradually start to get back to normalcy from COVID shutdowns and all of that. Now you have a chart over here that explains a very large disconnect where the share price of Sinopec is sitting all the way down in the low 40s or mid 40s, while the manufacturing PMI has made a tremendous recovery all the way up, to now near 54 level, which means expansion phase. You think this gap will close? There will be time when Sinopec will catch up with the manufacturing improvement and close this gap.
Yep. So for the first and third themes, this is in relation to Asian chemicals being a beneficiary of early phase recovery and buy China, build China. If we look at this chart on the left, we can see that PMI tends to be closely correlated to Sinopec's stock price. In the attached write-up, we can also see a similar comparison with crude oil prices. This also works with the official PMI, but I just trust the case-in PMI more than I trust the official one. But recently, there's been a disconnect between Sinopec shares and the manufacturing PMI, even though Sinopec hasn't really changed all that much as a business. So something has to give here, and I think this disconnect resolves itself with Sinopec stock re-rating. So that's what I'll say for those two themes. Now for the remaining theme, which is Chinese petrochemical players being in a unique position. So remember when I said that elevated natural gas prices will actually put US ethane-based competitors at a disadvantage compared to Asian naphtha-based petrochemical producers. So with natural gas prices close to $3 versus year ago $2, this is becoming a favorable scenario for Sinopec. So the next direction for gas prices here, as according to the bottom right table, is seen as more likely to be up, 30% higher compared to 2020. And if we go to the next slide, one of the main reasons for this is that the US gas producers continue to be unwilling to increase investment and production, as shown by all the recent Q3 earnings commentary. This is not due to the pandemic, like they were already conservative prior to COVID-19. It's because the US natural gas industry used to be notorious for irresponsible cash burn and shareholder value destruction over the past decade, which resulted in horrible balance sheet. And so the resulting exodus of investor capital beginning around 2015, 2016, that has led to these companies now having to prove their friendliness to shareholders by being extremely conservative. And so this is contributing to the rally we've seen in nat gas prices, which in turn is benefiting Sinopec.
Excellent stuff. So many tidbits of information that basically points towards improving direction over here. Moving on to the last bull case that is presented. There are two biggest headwinds actually in this particular case. Tell me about these.
Yeah, so one thing you may have noticed is that shares began declining. Shares of Sinopec began declining in late 2018, which is long before COVID began. So you might be wondering why it was falling even back then. Basically, it comes down to a couple things. First, we had the US-China trade war, which one can say resulted in China bringing in less oil from the US and instead upping their shipments from Iran, despite the Trump administration sanctions. And so because Sinopec is a state-owned enterprise, they've been essentially forced by the Chinese government's decision to take oil in from Iran and also Sudan, which is another country that's been in the US's crosshairs. So because of this, there's been this fear over the last couple of years that Sinopec would sooner or later get sanctioned directly by the Trump administration. And that's the short explanation of why shares have been beaten down, even though the company itself wasn't exactly bad fundamentally. Now, going forward, if we do get a Biden administration in charge, it's not to say that we expect trade tensions to completely go away, but I think it's safe to assume that at least a partial mending of the relationship, which means the worst of the sanction fears are now in the rearview mirror.
And I think that's precisely what it is going on. You know, just my recollection is that the when the Iranian deal fell apart under Trump administration, a whole bunch of new sanctions were imposed. Basically, no country was allowed to buy Iranian oil unless they got waivers to buy Iranian oil from Trump administration first. So selectively, the administration was releasing these waivers, and China was the one that was buying these waivers because previous to the deal falling apart, they were one of the biggest buyers of Iranian oil. If we're going to see mending of this relationship in under Biden administration, then the flow of oil should be much more ease, should happen with much more ease, than the previous administration. And as a result, this mending of relationship should lead to better growth and such going forward. It should also be positive, in my view, for the U.S. producers as well that had seen their shipments to China collapse because of the trade wars that could potentially come back under Biden administration. Now, on the last slide, you have a technical picture over here, short-term and long-term. Your technical picture points to that this stock could potentially double in the post-pandemic recovery. I mean, on the left-hand side, you have a scale here, long-term scale, with the stock sitting around mid 40s, which is essentially a 15-year low on the stock. And you believe that it can rise from 40, mid 40s, all the way to $80 per share. And on the right-hand side, this is a short-term chart, which is already breaking out from the downtrending resistance.
Yep. So one thing I'll add to that is what could cause explosive upside. In other words, the best case scenario is if China is allowed to continue importing oil from Iran, because right now they're discussing a multi-year deal with Iran, which would result in Iran selling discounted oil to China for the next several years. And so if Sinopec takes in that cheap oil from Iran and refines it while at the same time its downstream revenues are increasing, then we're looking at both margin. We're also looking at margin expansion in addition to revenue.
Yeah, so this is a very bullish outlook. How much time would you give the stock to get re-rated in a post-pandemic recovery, all the way up to $70 to $80 per share? What would be your holding period?
So this is a macro business cycle play. So I'd be having a time horizon of 12 to 24 months.
12 to 24 months. Excellent. All right, folks. So this is it. A bullish view on one of the largest Chinese oil company called Sinopec. As you know, that in recent weeks, we have turned quite bullish in the energy sector. We have discussed quite a bit in webinars and chat rooms as well. So this is one way of playing that as the Chinese economy continues to recover and the chart is breaking out and the long-term chart is at major support. That's it from us. Hope this was helpful. Please remember that the entire research note and slide deck will also be attached with this presentation on the website. So feel free to take a look at it and we'll see you next time. Thanks, Chronicle.